Hi, I'm Sam Brotman, and I'm here to talk about tax strategy. One of the things that frustrates me when I hear other people talk about tax strategy is that they're often referring to tactics and not actual tax strategy. One of my favorite books is The Art of War by Sun Tzu. Now, before you think I'm going to get all blue horseshoe loves Anacott steel on you, let me explain the premise of that book and why I think it's important, especially to this overall discussion. So, strategy is more than just executing things. Strategy is a broader understanding of what the playing field looks like and how to move the pieces across the board. You may have heard the expression, you want to play chess and not checkers. That involves strategy. Strategic thinking is going into a situation, having a proactive plan, and not just getting on the ground and executing a bunch of moves. It's about understanding what you're going to do before you actually do it. In the context of tax, a lot of people approach tax strategy when they go in to prepare their return, which is the completely wrong way to do it. When you're trying to plan out a strategy or execute a strategy, doing it at the return preparation process is about the worst thing you can do. Why? Because you're preparing a return in the year after the things happened. So for example, if I'm preparing a tax return for 2023, I'm actually doing it in 2024 after all the events have transpired for 2023. So I can't go back in time and do anything in 2023 in 2024 when I'm prepping the return that's going to materially change the outcome of that process. See how that's kind of backwards thinking? So strategy involves proactive planning. It's not just doing little things or making little changes or maximizing deductions. It's about coming in with a broader understanding of what a situation is. So what are the elements of that? Well, number one is we look at where the individual or where the business is today. What are the factors that contribute to their production of income? What are the characteristics of the business or the individual? What's really going on here? If you have a very clear understanding of where you're starting, you'll have an even better understanding of where you want to go. Which leads us to part two. Where do you want to go? What's the purpose of all this planning that we're doing? Where do we want to end up? What does that look like from a financial perspective? What does that look like from a professional perspective? What does that look like from a personal perspective? See, executing a good tax strategy is really about understanding where point A is, where point B is, and drawing a line between where you are today and where you want to go in the future. One of the biggest misconceptions of tax strategy is that the execution of the plan is simply designed to save money in taxes. Yes, saving money in taxes is important. That's why we're doing tax planning or tax strategy, is because we want to reduce taxable liability. But that's not really what the goal is. What the goal of any good tax plan or tax strategy is accumulating wealth or protecting the wealth that you have. You can interchange the word wealth and profit depending on whether you're referring to an individual or a business. But what ultimately do we want in our tax strategy? We want to maximize wealth. We want to maximize profit so we can use that wealth or profit for the production of better things. Understanding the distinction between tax strategy and tactics is a lot like understanding the distinction between a tax attorney and a CPA. So let's talk about CPAs for a minute. The term certified public accountant stands for somebody who is certified in the preparation of financial statements. When the certification Certified Public Accountant was created, it was created for the purpose that you wanted people who were preparing financial statements that could be trusted by the public. That's where CPAs come from. CPAs come from the idea that there was financial statements that need to be prepared and trusted. Eventually, CPAs migrated into tax return preparation. After all, your tax return is often the most important financial statement that most people or businesses prepare all year. So that's how CPAs got into tax. Now, CPAs are trained in compliance. They make sure that the form is filled out correctly and accurately so that you don't have any problems with the IRS or with the state government. So that's what a CPA's job ultimately is. It's compliance. It's making sure that you are in compliance with the tax laws. An attorney, on the other hand, focuses on advocacy and strategy. That's why attorneys go to law school. Law school teaches you how to advocate on behalf of your clients and how to put strategies in place in order to achieve overall objectives. Now, that's not to say that all CPAs can't execute tax strategies or can't originate tax strategies, but CPAs generally aren't trained for this. That's not what their background is. That's not what their job function is, and that's not what they do all day long. So asking a CPA to help you with your tax strategy is like getting the building code inspector to design your house rather than the architect. Can the building code inspector design the house? Maybe, but it's not what they're trained to do. You want to go hire an architect because the architect is the one who comes up with the strategy for the house. Now, when I talk about tax strategy with people, I like to break it down into two circles. So if I were sitting across from you today, I'd draw a left circle and a right circle on a piece of paper. The left circle is representative of your enterprise. I use the word enterprise because business doesn't necessarily encapsulate what everybody is doing. So think about your enterprise as all the ways that you generate income or earn money. All of that goes in the left circle. The right circle, on the other hand, represents you and your family. So we've got the left circle and the right circle. A good tax strategy starts with an understanding of the left circle. So if I draw the left circle on a piece of paper, the first thing I'm looking at is what's coming into the left circle. So that's your income. What are all the ways that the enterprise is generating money to feed into the enterprise? It could be business income, could be real estate income, could be capital gains, could be all sorts of things. The next thing I'm looking at in the circle is all of the expenses necessary for that production of income. It takes money to make money. So what type of expenses does the enterprise have in order for it to make its money? What's ordinary, necessary, and essential for the production of income within this enterprise? Finally, what I'm looking at is what's at the bottom of the circle, or the profit. So profit is income minus expenses, and that's what's left over. So now that I have profit, then I can look at the right circle. How much of my profit needs to move to the right circle so that the right circle can live the way it wants to live? Is it $10,000 a month? Is it $20,000 a month? Is it $100,000 a month? I tend to think of this as monthly because that's the way that most people approach personal financial planning. They think about their mortgage payment in terms of their monthly mortgage payment versus their yearly mortgage payment. So we break it down into a run rate to determine what your run rate is, and then we add any extra expenses that you may have on the personal side for the year. Now, personal expenses is a very wide term. It can mean things like, I want to support my family and make $250,000 a year of investments into real estate. Now, the reality is the real estate investments should be going back into the left circle. But if the right circle wants to think about it in terms of their personal savings versus what the business is generating, that's totally fine. So what we're coming up with is how much profit on a yearly basis do we need to support the monthly carrying cost for the right circle, plus any extra expenses. The right circle is going to get taxed at individual income tax rates for anything that is moved over into the right circle unless we can do something about it. So to trace this back, we're looking at the way income comes in through the enterprise, how much profit is ultimately generated after expenses, and how much of that profit needs to move to the owners in order for the owners to live the way they want to live. A good solid tax plan starts with an examination of the left side of the circle. First, how do we make the left circle as tax efficient as possible? What are the ways we can look at the way it earns income, the way it generates expenses, and ultimately the way it accumulates profit, and make that as tax efficient as we possibly can? Second, we're looking at how that profit passes over to the right circle. So we only want to move as much profit as we have to so the right circle can live the way that it wants to live in order to make the transfers of wealth between the left circle and the right circle as efficiently as we can. Because generally speaking, individuals are going to pay income tax at a higher rate than corporations. So if we determine that the right circle needs $500,000 to live the way it wants to live, we only want to move $500,000 in order to be totally and completely tax efficient. You see how that works? So we're coming up with a plan for how the enterprise earns its income and ultimately generates profit, making that as efficient as we can, and then making distributions to the right circle or to the family unit as efficient as possible as well. That's ultimately the building blocks of a good tax strategy. Okay, got the mindset surrounding tax strategy? That's great. Now let's dive into the two biggest drivers of what ultimately will produce the best tax strategy. Driver number one is the structure or choice of entities surrounding the enterprise. So what do we mean by that? Businesses often will set up a corporation or a partnership or an LLC when they're itty-bitty tiny businesses. Over time, the business will grow and change and change. For example, if you're a business owner, the business that you started 10 years ago, 20 years ago, is not the same then as it is now. You've had all this time pass, all this different evolutions, and ultimately, you have a completely different business. So the question is why do you still have the same corporate structure from when you were a baby business to where you are now? And furthermore, is the structure you have now really going to get you to where you want to be? When the business or the enterprise does the types of income and the types of profit levels that you're generating, is this really the most efficient way to do this? So start with that. Is the shoe that I'm in today the shoe that I need to be in order for my foot to grow the way it needs to grow? Question number two, am I paying tax in the appropriate state? Now, this is a tricky concept because a lot of people live in a state and consider themselves to be residents of that state, which they are, but they also consider their businesses or their enterprises to be residents of that same state. While that may be true for certain types of businesses, you need to think about your business in a different way perhaps if you have multiple ways of generating income in different states. So here's an example of this. Think about this as a big pie. So if I drew a big pie on a piece of paper, what is the most appropriate jurisdiction for your income to be taxed in? Now, from a business's perspective, you could argue that the most appropriate jurisdiction is where the business is located. Where is the business located? Well, it's where the employees are, or it's where the seat of management and control is. These might be two different answers. And then furthermore, maybe the business is located in the place where it's providing benefit to its customers, where the customer is located. If you've got a business that's selling goods online, it may be providing benefit to businesses in all 50 states. It may be providing benefit to businesses or individuals that are international. Think about that. So what we're talking about here is we're talking about the concept of fundamental fairness in taxation, but we're really talking about jurisdictional arbitrage. And that's the analysis that tax attorneys do. When we look at a business, we look at how the business is taxed and where it's being taxed, and we ask the question, is this the appropriate place for the business or the enterprise to be taxed? And if not, what are we going to do about it? Now keep in mind that circles are different. You have a left circle and a right circle because your enterprise is not your family unit. Your enterprise is something you have created. It is a living, breathing, organic thing, and it is separate and distinct from you. So while you may be located in California or Texas or Florida or New York, it doesn't necessarily mean that your business has to be located there. Think about most larger corporations that you know. Most larger corporations are located in Delaware or Nevada. Why are they located there? Well, they're located there because there are advantages to having your businesses in those jurisdictions. Some of those advantages relate to tax, other advantages relate to other things. But the point is, both how your entity is structured, both how the way that your enterprise is built, and where it's located are two particularly important components in tax strategy. When I hear people talk about business deductions, I'm thinking they're talking about the side dish and not the steak. You want to be talking about the steak. You want to be talking about the apparatus that's going to earn you money. And you need to think about these things strategically. Think about yourself for a minute. You wouldn't be at the place you are in life today without strategic thinking. And strategic thinking is the way that you should be making most of your decisions. If you're building a house, you're not just going to go in the project and start tearing down walls. You're going to hopefully hire an architect. If you get sick, or better yet, you want to be proactive about your health, you want to go see the doctor so the doctor can build a strategy for you to build a healthier lifestyle. That's the purpose of a good strategy, and that's the way that most entrepreneurs and most enterprise owners run their life. You didn't get to where you are today without strategic thinking. And so that same strategic philosophy is how you want to approach your taxes. You don't want to be reactively going through the return and trying to figure out what little nips and tucks that you can make in the return process to save you a couple of grand. You don't want to be doing things by going to your accountant and asking them in the middle of the year what adjustments you should make. No, real strategy is looking at where you are today versus where you want to go and building out a multi-year plan to get there. These are your goals. The reason they're your goals is because they're important to you. And so in order to achieve your goals, you need real concrete planning and a real strategy that undermines decisions. That thinking drove you to where you are today, and it's what's going to get you to where you want to be in the future. What you've done in the past may not necessarily be what you need to do to get to that next level. So it's up to you to implement a real tax strategy to change your future. Change your thinking, change your mindset, change the way you plan, alter your execution, and change your results.